Welcome back to HarborFinancialOnline.com. Today I'm going to be going over IRA contribution amounts and how much you can contribute each year and get the full deduction from the IRS, which ends up being a bigger refund for you when you file the return. So I put together a presentation on the bigger points of contribution amounts and how you can get the full deduction each year. So let me bring up the presentation for you. The most important thing you need to realize with IRA contributions is that there are age requirements which will determine how much you can contribute each year and deduct each year on the tax return. If you're 50 and younger, you can contribute towards your IRA $5,000 up to $5,000. So if you contribute $5,000, you'll get a $5,000 deduction on the tax return when you fill it out. If you're over 50, you'll qualify for $6,000, so you can contribute $6,000 and get a full deduction on the tax return for $6,000. Now you may have instances where if you're married, one spouse may be over 50 and one under 50, so you would get 11, you'll get 5 and 6. Or you may both be over 50, and you'll get 12,000 is how this works. So it's not specific to how you file on the return. If you're filing separate, married, that doesn't affect the contribution and deduction amounts. It's just age and how much you contribute each year on this. Now if you file during the year, if you file less than the maximum contributions, what there is out there is called a catch-up rule, where say the tax return is due April 15th each year. Say you wait till April 10th to file the return and you're under 50 and you can contribute up to $5,000, but in the year you only contributed $3,000. Now when you file the tax return, you could put another $2,000 on that date, contribute, and now you're up to your $5,000 max. So this is called a catch-up rule. This is for people that didn't contribute the maximum amount each year to get that deduction. So this is a benefit to you, because that day of you file that return, you can get the maximum deduction amount by contributing to your IRA on that specific day. So that's a good rule where the IRS is helping you out to get a bigger refund and a bigger deduction on your return. Now during the year, if you contributed more than the allowable amount, say $5,000, if you're under 50, what the IRS allows you to do is carry over any of that excess amount to the next tax year and apply it to that next tax year as a deduction. So say this year I applied $5,000 and got that full deduction, but I accidentally went over, did $7,000. Well, in the following year I can take $2,000 and put it to that next year and get the deduction in the following year. So you don't lose anything. So that's good to remember. Some people will forget in the following year to apply it to the following year, that excess amount. So you should remember that when it comes time to calculating your contribution amounts. Contributions can be made anytime before you file a tax return for that year. How that works is throughout, say you have to file the return on April 15th. Most people will normally file the return in March. It's usually about the average. So you'll have basically a whole year up to that March to contribute towards your IRA account and get the deduction on the tax return, which will end up being a bigger refund. So that's good to know. And I want to point out at the bottom of the presentation, I do have a link here to HarborFinancialOnline.com where we offer more information on IRA contributions and how you get the deductions. And actually on the link here to our site, you can prepare your return directly online, and it has a bunch of different calculations and estimators that will let you know how the contributions will give you more deductions and give you more refunds. So if you get a chance, you might want to check out our site and see what we have to offer there for IRA contribution estimators and determining what you can deduct each year because of that. There is a maximum age for contributions that will affect some of you out there. The age is 70.5 years old. If you've reached this age, you no longer can deduct any IRA contributions, so that's something to remember for some of the retirees filing returns, that you don't want to be contributing towards that while still expecting to get a deduction. Now, contribution limits are phased out and can be excluded if your employer offers you a pension plan like an IRA. So you need to talk to your employer and get the amounts that they're contributing towards your IRA, because those amounts will still apply to any other separate IRA that you have set up on your own. So if your employer is applying $3,000, you can only do $2,000. So the max rule still apply to this. Again, check out our website, harborfinancialonline.com. You can prepare your tax return directly on the site and learn a lot more about IRA contributions and how it will affect you and how to get the full deduction amount. So thank you for checking out the video. Send me an email if you have any questions, expert@harborfinancialonline.com, and hopefully you'll check out our future videos. Thank you.